Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now it's the first Friday of the third quarter of the year, and we've been spending some time, including on last week's podcast, discussing just how eventful the first half of the year has been. Indeed, the second quarter. But once again, worth reminding ourselves that despite all the volatility of events, equities have still done well, especially through the second quarter of the year. But of course, we're now approaching crunch time, particularly on US trade tariffs and the pause that's due to expire next week. So, how should investors position themselves ahead of the next set of events? So, to discuss that and more, I'm joined today by Audrey, who's head of asset allocation at the CIO office. Thanks, Audrey, for joining us as always. So, first half dominated by headlines around Trump's trade war. But as we are looking ahead to the second half of the year, how do you see the US economy evolving?
Well, thanks, Manpreet. The first half was very much about trade tension and the market reacting to that uncertainty, but I see the second half to be shaping up quite differently. So, on one hand, US growth is clearly slowing, and after 4 years of fiscally fueled expansion post the pandemic, we are starting to see cracks. So, soft data like consumer as well as business confidence has been relatively soft for months now, but now we are also seeing hard data weakening too. Say, for example, while the non farm payroll rose unexpectedly in June, almost all the gains came from government jobs. Private sector hiring was the weakest since October last year, and continuing jobless claims are also at their highest since 2021. And consumption, which is still the main driver of US economic growth, is clearly slowing. So, real personal spending, in fact, contracted in the month of May. But that being said, on the other hand, there are also some powerful offsets coming into play. We've got the new US budget, which includes the US dollar $4.5 trillion worth of tax cuts. And the administration have also raised the debt ceiling by another $5 trillion. That's a huge fiscal boost, roughly around US 3.4 trillion over the next 10 years. And it should help to counter some of the drags from tariffs as well as the high interest rates that the economy has been experiencing. And you combine that with trade agreements that the US is signing with its key partners over the next couple of weeks or even months, we could clearly see uncertainty ease a bit from here. And plus, if the job markets were to deteriorate further, that could also hasten Fed rate cuts. And markets are already pricing in 50 basis point of cuts by year end and potentially more into 2026. So while there could be some near-term bounce in the US dollar for that matter, over the next 6 to 12 months, we are in fact positioning for US dollar weakness and would prefer to diversify into non-US equities as well as emerging market local currency bonds.
Thanks, Audrey. Let's stay on that point on equities for a moment because I get the case for non-US equities, but what's your outlook for US equities themselves?
So we view US equities as a core holding. The S&P 500 index is now at a new record high. Subsiding risk in the Middle East, as well as the passing of this one big beautiful bill, have clearly been driving US equities higher. That being said, valuations are not cheap. US equity stands at about almost 2 standard deviation rich above its historical average, and sustained earnings growth will be needed to justify this valuation premium. And obviously, a clear sort of a hurdle, a checklist that will be coming through will be the Q2 earnings season, which will be kicking off in about 2 weeks' time. Soft data remains under pressure, and there's also uncertainty around whether US trade negotiation will extend beyond its 9th July deadline. So, what this means to us is US equity clearly face pullback risk at this current elevated levels and valuation. So, we would suggest taking advantage of the current strength to actually trim excessive long exposure in the US and then add that into other regional markets, for example, in China or Korea within Asia. And within US itself, we expect rotation into major US banks. This sector is riding on expectations of a relaxation by the Fed in the enhanced supplementary leverage ratio for the banks, as well as the passage of the Fed's annual stress test. And we also expect further deregulations to help to support US banking sector equities going forward as well.
All right, let's shift gears to bond markets. So, unlike equities, US 10-year government bond yield has been on a downtrend since the end of May. So, how should investors look for opportunities in bond markets?
So we're bullish on emerging market local currency bonds. Many emerging market economies have significantly strengthened their fiscal as well as current accounts in recent years. And this, together with rather benign inflation outlook, bolstered by expected reduction in US interest rate as well as a weak US dollar, have basically resulted in pretty high and attractive real yield when it comes to emerging market economies. And these vectors should enable EM central bank to cut interest rate. And together with our weak US dollar view, is why we are overweight on emerging market local currency bonds. From a shorter term perspective, we are opportunistically bullish on EM Asia local currency bonds. A weaker US dollar is likely to attract more inflows into this asset class, which offers diversification benefits due to its low to moderate correlations with major developed market bonds.
Okay, you'd referred to sort of the potential for a dollar rebound earlier, but then when I look at euro dollar, we're trading close to a 4-year high. So, what's your view on the euro dollar pair?
So euro has gained over 10% against the US dollar this year, and that is prompting concerns among ECB officers that whether further appreciation could undermine the central bank's 2% inflation target, as well as this ongoing economic recovery. So a move in US dollar in euro US dollar above 1.2 is expected to trigger stronger ECB pushback, including the likes of verbal intervention or even further rate cuts to counter disinflationary pressure within the economy. So our longer term weak US dollar bias notwithstanding, we believe that Euro US dollar pair is currently overbought and thus look a bit technically challenged. And this pair has been grinding higher while its relative strength indicator, which is RSI, is diminishing in strength, thereby suggesting waning momentum. So therefore, we also expect a partial unwind in terms of stretched bearish US dollar positioning. So this dynamic, this push-pull dynamic, basically support a rather range-bound view when it comes to the euro-dollar pair. We're expecting between 1.14 to about 1.2 as a range.
And finally, just going back to equities again, you'd highlighted Korean equities as one possible option within Asia. What's Can you tell our listeners a little bit more about that view, given we've just had a passing of the new Commercial Acts Amendment Act by the Korean Assembly?
Yes, so the South Korean Parliament recently passed the Commercial Act Amendment on the 3rd of July, with proposals such as expanding directors' fiduciary duties, mandating the adoption of electronic general meetings, as well as enhancing the application of 3% rule. So this revision to the Act is expected to better protect minority shareholders' interests as well as support corporates' valuation. So we've seen markets reacting favorably following the passage of this act, and we continue to remain bullish on Korean equities over a 12-month horizon. If you look at valuation, they continue to look quite cheap, with Korean equities trading at about a 28% discount to AXJ equities, despite the strong rally since the 2nd of April. And further fiscal expansion plans under President Lee's administration, such as via the revamp of the tax system, as well as improving corporate governance, and also the weak US dollar can basically stimulate the region's, the country's earnings growth projection in our view, and ultimately help to narrow Korean equities discount with AXJ equities.
Okay, thank you, Audrey. I think that's about all the time we have for today. So thanks so much for taking the time to go through these questions for our listeners. If I can, as always, summarize my top takeaways from the conversation. Number one would be to use the strength in US equities to rebalance into our preferred non-US equity markets or preferred sectors like banks within the US. Second would be just to highlight that we do see emerging market local currency bonds as the key opportunity to go overweight within bonds. And third, more short term, we'd consider trading the range in euro dollar as the US dollar stages a brief rebound. So that's it for today. Thanks very much for joining us. We hope you enjoyed the podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, Visit Market Views on the go on our website or click the link in the description.